Hello guys, how are you? Welcome to my YouTube channel Technical World. So today's topic is about what is a mortgage, its types, how they work, and its examples also. So here we go. What is a mortgage? A mortgage is a type of loan used to purchase or maintain a home, land, or other type of real estate. The borrower agrees to pay the lender over time, typically in a series of regular payments that are divided into principal and interest. The property then serves as collateral to secure the loan. A borrower must apply for a mortgage through their preferred lender and ensure that they meet several requirements, including minimum credit scores and down payments. Mortgage applications go through a rigorous underwriting process before they reach the closing phase. Mortgage types vary based on the needs of the borrower, such as conventional and fixed rate loans. How mortgage works. Individual and businesses use these mortgages to buy real estate without paying the entire purchase price upfront. The borrower repays the loan plus interest over a specified number of years until they own the property free and clear. Most traditional mortgages are fully amortizing. This means that the regular payment amount will stay the same but different proportion of principal versus interest will be paid over the life of the loan with each payment. Typically, mortgage terms are for 30 or 15 years. Mortgages are also known as liens against property or claims on property. If the borrower stops paying the mortgage, the lender can foreclose on the property. For example, a residential home buyer pledges their house to their lender, which then has a claim on the property. This ensures the lender interest in the property should the buyer default on their financial obligation. In the case of foreclosure, the lender may evict the resident, sell the property, and use the money from the sale to pay off the mortgage debt. The mortgage process would be borrowers begin the process by applying to one or more mortgage lender. The lender will ask for evidence that the borrower is capable of repaying the loan. This may include bank and investment statements, recent tax returns, and proof of current employment. The lender will generally run a credit check as well. If the application is approved, the lender will offer the borrower a loan of up to a certain amount and at a particular interest rate. Home buyers can apply for a mortgage after they have chosen a property to buy or while they are still shopping for one. A process known as pre-approval. Being pre-approved for a mortgage can give buyer an edge in a tight housing market because seller will know that they have the money to back up their offer. Once a buyer and seller agree on the term of their deal, they or their representative will meet at what's called a closing. This is when the borrower makes their down payment to the lender. The seller will transfer ownership of the property to the buyer and receive the agreed upon sum of money, and the buyer will sign any remaining mortgage document. The lender may charge fees for originating the loan, sometimes in the form of points at the closing. Options. There are hundreds of options on where you can get a mortgage. You can get a mortgage through a credit union, bank, mortgage, specific lender, online only lender, or mortgage broker. No matter which option you choose, compare it across to make sure that you are getting the best deal. Type of mortgages. Mortgages come in a variety of form. The most common type are 30-year and 15-year fixed rate mortgages. Some mortgages terms are as short as 5 years, while others can run 40 years or longer. Stretching payment over more years may reduce the monthly payment, but it also increases the total amount of interest that the borrower pays over the life of the loan. Within the different term length are numerous types of home loans, including Federal Housing Administration (FHA) loans, U.S. Department of Agriculture (USDA) loans, and U.S. Department of Veterans Affairs (VA) loans, available for a specific population that may not have the income, credit score, or down payment required to qualify for conventional mortgages. The following are just a few examples of some of the most popular type of mortgages loans available to borrowers. Fixed rate mortgages. The standard type of mortgages is fixed rate. With a fixed rate mortgages, the interest rate stays the same for the entire term of the loan, as do the borrower's monthly payment toward the mortgage. A fixed rate mortgage is also called a traditional mortgage. Warning: mortgage lending discrimination is illegal. If you think you have been discriminated against based on race, religion, sex, marital status, use of public essential, national organ, disability, or age, there are steps that you can take. One such step is to file report with the Consumer Financial Protection Bureau (CFPB) or the US Department of Housing and Urban Development (HUD). Adjustable rate mortgage. With an adjustable rate mortgage (ARM), the interest rate is fixed for an initial term, after which it can change periodically based on prevailing interest rates. The initial interest rate is often a below market rate, which can make the mortgage more affordable in the short term but possibly less affordable long term if the rate rises substantially. ARMs typically have limits or caps on how much the interest rate can rise each time it adjusts and in total over the life of the loan. Interest only loan. Other less common type of mortgage such as interest only mortgage and payment option (ARMs) can involve complex repayment schedule and are the best used by sophisticated borrowers. This type of loans may feature a large balloon payment at its end. Many homeowners got into financial trouble with this type of mortgages during the housing bubble of the year 2000s. Reverse mortgages. As their name suggests, reverse mortgages are a very different financial product. They are designed for homeowners aged 62 or older who want to convert part of the equity in their home into cash. These homeowners can borrow against the value of their home and receive the money as a lump sum, fixed monthly payment, or line of credit. The entire loan balance becomes due when the borrower dies, moves away permanently, or sells the home. So today's topic is over. We will continue this topic in next videos. Goodbye.